the Dow of about 300 points. In fact, we were over 32,000 in the Dow, considering where we were after 2008, below 7,000, and again, an extraordinary testament to the resilience of the U.S. economy. So all that's great. In the rate markets, though, in the Treasury markets, we see that the 10-year is just below 160, 1.6%. In January, it was just below 1%, so it's picked up better part of 60 basis points. Is that a bad thing or a good thing?
It's a bad thing.
Look at it.
It's a bad thing.
It
Why
depends
is it
who
a
you're
bad thing?
asking.
Or is it
Very depends.
Could be a hint to inflation.
It could be a hint to inflation. In other words, higher interest rates are a natural byproduct of a healthy and expanding economy. What you're seeing in the rate markets is concern about rising inflation and when and by how much the Fed will raise interest rates. What has the Fed been doing, though, over the course of the last year with a good degree of regularity in terms of the markets?
Buying bonds.
Well, it's in buying bonds, but I'm talking about communicating. I'm talking about communication. I'm talking about signaling.
Still 2022.
Exactly. The Fed's doing everything it can to telegraph to the capital markets exactly what its plan is, which is to remain vigilant in its accommodative or supportive stance of the economy with no rush to raise interest rates at the first hint of inflation, which, as we have said now multiple times, is to be expected with a recovering economy. The 2 and 10 year, in fact, I made a note just before we started class. The 2 and 10 year at the start of the year was trading at, the 2 and 10 year spread was at 82 basis points. Right now, today, the 2 and 10 year is at 142 basis points. So that means that the curve is doing what? Is it flattening? Is it normalizing? Is it inverting, or is it steepening?
Steepening.
The curve is steepening, which is what we would expect at the beginning of a recovery, which is exactly where we are right now. And the expectation that all of the pent-up demand that we've seen is going to really begin to gain some traction as everything reopens. Before we go further, I wanted to pick up the slideshow. We're gonna spend some time tonight talking about options, and I read through some of your there's some of the chat that goes on while we're having class over the course of last week, and obviously some of you are reasonably well versed in puts and calls and other types of options. I will certainly look forward to your helping me out, giving me assist as we wade into that territory later on today in this class, and of course then throughout the semester. I posted for you answers to chapter 2, and so those went up earlier today. You should have those. Let's hit the record button, and
this meeting is being recorded.
Let's get that screen up. So last week we got some real interesting data on Thursday and Friday. We saw that initial jobless claims were up at 745,000, still an extraordinary number to see month after month. We saw a big number in non-farm payrolls, which is why we saw a big pop in the market on Friday, as I'm sure all of you are watching, at 379,000. The unemployment rate notched below just a tick from 6.3 to 6.2%. Average hourly warnings were up at 0.2%, and the trade deficit widened. Let's first take a look at the labor numbers. What's the story here about the labor market? It seems to me that the story here is confirming what we've been saying all along, that in anticipation of an opening of the economy, that businesses are rehiring, businesses are bringing people back off of furlough, that there is a consensus expectation that growth is going to be very strong. In fact, the headline on Friday was that the surge in hiring as the vaccine distribution accelerates the economy in initial stages of reopening. In the coming months, we should see robust gains in all sectors, which is more or less what we've been saying all along. In fact, I think it was Guy who said last week that we should expect to see a major pop in retail hiring. And in fact, if you dig deeper in the non-farm payroll numbers on Friday, that's where the majority of hiring was, in retail stores, restaurants, in hotels, because with the opening of the economy, the expectation is that people will begin to flock to places that they would otherwise avoid when we were in the midst of the worst days of the pandemic. What I wanted to do is take a look at these 4 charts here and start in the upper left-hand corner, working clockwise. You see, we see non-farm payrolls. We see a loss here of roughly 22, 23 million jobs here. We see here non-farm payrolls. We see a recapture of about 12.5 million jobs, leaving a balance of about 9.5 million jobs from the peak in February of 2020 in terms of the labor market. We see an employment rate that continues to come down from a peak in 2020 of April of 14.8% down out of 6.2. And as we would expect, we see continuing jobless claims, state and federal jobless claims coming down from a high of nearly 25 million in the spring to where we are now just below 5 million. And then on our last chart here, we see since 2009, since the depths of the Great Recession, we see average hourly earnings. The takeaway here is twofold. It seems to me that, well, you see the economy recovering slowly but surely, perhaps more slowly than we would like if we look at the non-farm payroll numbers that haven't been as robust as we would have hoped for. Nevertheless, the unemployment rate and continuing claims are coming down, going in the right direction. What's the caveat here with regard to average hourly earnings? What's the exception? What's the takeaway?
It hasn't changed much.
That's exactly right. So you have unemployment that's plummeting, claims are plummeting, the economy continues to expand, but average hourly earnings stay roughly static, or stay roughly low. The growth is very small. So if we look here, if we extrapolate that and look further, since the depths of the Great Recession, wage growth against the unemployment rate just before the pandemic set in the spring of last year, we see that wage growth has been relatively modest as the unemployment rate soared and then came back down. At the same time, if we look more specifically or granularly at median household income since 1990 over the course of the past 30 years, you see that the growth rate is less than 1%, from 56,000 and change in 1990 to 68,400 in 2020. Moving further, you look at the compound annual growth rate of the Dow between 95 and 2020 over 25 years, and what do you see? That it's actually about 6.3% in the compound annual growth rate. So there's a big disconnect there between average hourly earnings and what a relatively small group of people relative to the adult population are able to derive from exposure to the stock markets. We know that 80% or 85% of the stocks are held by about 10% of the people. So the vast majority of people don't have any real exposure to the stock market, and only 50% are really fully exposed. So I just wanted to leave that there in terms of looking at another data point with regard to the direction of income inequality in the country and the growth in changes in the labor markets. From there, I want to turn our attention.
Sorry, I had a question. In regards to compounded annual growth rate, is it acceptable to pronounce that as the acronym as CAGR, or is that not acceptable? Because I've heard that before, and I just want to confirm that.
To say CAGR?
Yeah.
Sure, absolutely. Okay, I mean, the acronym, to pronounce the acronym.
Right. I just wanted to make sure.
Absolutely, okay. Sure. Okay. So the other data point that came in on Friday was the trade deficit. So what do we see here? We show the U.S. trade deficit between 2000 and 2020, and the U.S. continues to run trade deficits for the reasons that we've talked about. What happens in 2001 that really changes the calculus in terms of global manufacturing? Somebody joins the World Trade Organization in 2001.
Was it China?
It was China. China joins the WTO in 2001. And of course, the manufacturing sector has never been the same as more and more production moves to low-cost labor markets, particularly in China. If you look here, I took out selected years showing the U.S. trade balance from 2000 on to 2020. Other than the contraction in trade that we can attribute to the trade war that Trump initiated in 2018 and the drop in trade following the Great Recession here in 2008, what's the general trend here? The general trend is that imports are increasing and exports are increasing in the U.S. Has the U.S. dollar as the reserve currency for the world changed very much over the course of the last 20 years? No, it has not. It remains a destination for capital from all over the world as the de facto safe haven currency in the global international monetary system. And so the likelihood is that the U.S. will continue to run trade deficits, while China is likely to run trade deficits. I thought it was interesting. It'd be interesting to look at here I made the point. Where does the U.S. run deficits? Runs deficits with countries that produce things more cheaply than the U.S. here, that don't need what the U.S. is good at making, or trade everything with the United States, but the U.S. Still imports more than it exports. Okay, those are very straightforward reasons. If we look at the U.S. versus the China's trade balance, what do we see? We see that the U.S. consistently runs trade deficits, and China consistently runs trade surpluses, as we would expect from a low-cost exporter. As I said, we expect that the U.S. trade deficit is going to continue as the U.S. reopens and the dollar remains strong. And will surpluses remain in China? Sure, surpluses are going to remain in China, I think, for two reasons. Their exports are surging, and there's a slowdown in overall economic growth in China from where it was at 8 or 9% down to where it is over 6%. And so their demand for foreign goods has not as strong as it was before, and has shrunk their imports. Nevertheless, that's my only other point here. Pardon me just a second. Was there any comments or questions here? Looking at the deficit in the U.S. and surplus in China? Okay. Again, for information purposes, as we begin to look more closely at trade balances and the importance of trade relationships. So last week, I pointed out that China runs some trade deficits, and one of you mentioned that China tends to be a big surplus country, and it is. Right now, its surplus is about $400 billion in trade this year. So it exported 2.5 trillion, imported 2.1 trillion. So its surplus is about $400 billion, but it maintains trade deficits with other countries around the world. And this shows you this shows you the most recent numbers and the top 5 countries in which China maintains a deficit, from Taiwan to Switzerland, including South Korea, Australia, Brazil. But again, on the whole, China maintains a surplus. This year, I'm pretty sure about that it was a $400 billion surplus. Are there any comments here? I just wanted to clarify that. China is a surplus nation, but does maintain trade deficits with some of its trading partners. Any questions or comments here? Okay, then let's turn to chapter 2, question number 12, which I want to go through before we move on to new material in chapter 3. Okay, so here we were told the maximum amount of steel or aluminum that Canada and France can produce using all the factors of production at their disposal. And so we plotted, what I did is I plotted here for you. Hold on a second. Given all available resources, we see what Canada can produce, which is 1,500 tons of aluminum or 500 tons of steel, and everything that France can produce, which is 1,200 tons of steel and 800 tons of aluminum. As a result of that, we're able to calculate the marginal rates of transformation aluminum into steel, and clearly we're able to identify the fact that Canada has a comparative advantage in the production of aluminum, and France in the production of steel. The first question asks us to determine the marginal rates of transformation. We've done that here. If there are any questions, we're going through this problem set that I asked you to do last week ahead of today. Please jump in and ask as we go through this. So now we see at pre-specialization autarky, we're told that Canada is going to produce 600 tons of aluminum and 300 tons of steel, while France will produce 600 tons of steel versus 400 tons of aluminum. So this is where we are at autarky. If they reallocate their resources, this is where Canada is at 500 and 1,500 tons of steel and aluminum respectively. as opposed to France at 1,200 and 800 steel to aluminum, respectively. And then we have our pre-specialization autarky plotted out. Next, we're told the post-specialization production point. We know in France, because France is starting in Canada, Canada is going to produce aluminum. So it's producing 1,500 tons of aluminum, while France is producing 1,200 tons of steel. Pardon me, just a second. Okay. So what is the net gain here? We see that after specialization, right, just as we said, Canada is producing 1,500 tons of aluminum and no steel, whereas France is producing, France is producing 1,200 tons of aluminum and 1,200 tons of steel. So what's the net? The net is there's a gain of 500 tons of aluminum in the world, and there is a gain of 300 tons of steel in the world. Yes? We went from 1,000 tons to 1,500 tons. We went from 900 tons to 1,200 tons. That's the answer. So the gain is 500 and 300. That's the answer. Next, the question is you have a trading possibilities line of 1 for 1. So we're going to draw a line from the post-specialization production point here, which is in Canada, it's 1,500 and 1,500, and in France, it's 1,200 and 1,200. That's your trading possibility line. So what do we know is going to happen? We know
Professor?
that, yeah.
Is it always going to be 1-to-1, the trading possibility line?
Well, presumably,
Because if they meet in the middle, it's going to be 0.915, right?
if
Because
they meet in the middle, they're going to be 0.915. But for our purposes here, the marginal rates of transformation are as we've defined them. And on an exam, I'm not prepared to answer that question now. I'll be prepared to answer
Okay, no
that
problem.
next week.
no
but-
problem.
For the moment, let's make our way through this.
So you decide arbitrarily on 1-to-1, right?
Well, I didn't decide. The book told us. The book told us, assume that
Okay.
Canada and France agreed to a terms of ratio on a 1-to-1 basis. So I'm just plotting what the book is asking. And I'm going
Got
through
it.
the answer with you. So we
Apologies.
plotted that out. And so now we know what's going to happen is that Canada, autarky. Think of it like autarky. That's given. I gave that to you. That's given to you. Okay. Right. Okay. So now we know what's going to happen is that Canada is going to move up along its trading possibilities line, and France is going to move down its trading possibilities line to come to some equilibrium point that will be their post-trade consumption line. And we're told that assume 500 tons of steel are traded for 500 tons of aluminum. So that just means that here we go. Canada is moving up 500 tons on its trading possibilities line. At this point, what's happened? Well, it's exported 500 tons. Canada has exported 500 tons of aluminum. Yes. And France is moving down its trading possibilities line, where it is now exporting 500 tons of steel. In fact, the way that I drew this, though, pardon me, the exports from Canada, it's 500 tons of aluminum, become the imports of aluminum in France. I apologize for the confusion there. Let's look at that again. Here we are with our trading possibilities line. Canada is going to move up its trading possibilities line until it's exported 5 tons of aluminum to France, which is going to import those 5 tons here. At the same time, France is moving down its trading possibilities line until it's exported 500 tons of steel. We draw a line here straight across to intersect with the trading possibilities line, and we see our exports and imports there. At the same time, those exports become imports in Canada, those 500 tons. So Where are we now after trade? Well, after trade, here's the post-trade consumption point in Canada, which shows an increase of 400 tons of aluminum, 1, 2, 3, 4, and 200 tons of steel. Next, we see the post-trade consumption point in France, which shows an increase of 100 tons each of aluminum and steel. Moving beyond that, we have our terms of trade, which are indicated here. We have our import-export terms of trade. Same thing down here in France, our imports-export terms of trade. This identifies for us the trade triangle. And there's our trade triangle right there, indicated by the terms of trade, the imports and exports, pardon me. Okay. Any questions? That's what an exam question might look like. If you have questions, follow up with me on that, please do so. And let's move forward. Okay, so we've been working now for a while on the framework of modern trade theory. We spent some classes on that. First, we look at globalization, we look at modern trade theory and the ideas of comparative advantage. We looked at gains from specialization, production gains from specialization, consumption gains from trade. And now the question of what are sources of comparative advantage? So let's take a moment now and look where we've been. We started with the mercantilists who really defined the idea of protectionism. I mean, mercantilist theory is protectionist in its essence. The idea of encouraging exports, discouraging imports, really discouraging trade, encouraging nations to maintain surpluses at all costs, because for one nation to do well, another nation has to do badly. So the mercantilists saw trade as a zero-sum game. Wealth is fixed, and the precious metal that's owned defines the wealth of a nation. And again, that surplus should be maintained. Next, we moved on to David Hume, who really addresses the mechanics of mercantilism and says that the idea of nations being able to maintain trade surpluses indefinitely is just wrong, because a nation that maintains surpluses and only encourages the inflow of precious metals is going to see inflation in the country, is going to see an increase in the value of its currency, and therefore it's going to see an increase in exports, an increase in its imports, a decrease in its exports, as its rising currency makes its exports that much more expensive relative to other nations. That's going to close or erase the trade surplus and become a trade deficit. That's by the price specie flow mechanism under Hume. It's not until we get to Adam Smith that the thinking in the in the 1770s arrives that trade is actually beneficial, that trade should be based on absolute advantage, that all labor was homogeneous, that labor was the sole factor of production, and that we define as the labor theory of value. Next, we went on to Jean-Baptiste Say, who establishes a fundamental idea of classical economic theory that supply creates its own demand, which essentially says the government doesn't need to do anything. If there's a period of deflation with prices falling, demand will increase. That will lead to the economy returning to equilibrium. All that's fine in case there's a problem. If there's any type of disruption to longer term trends, that's when we need the government to step in, which is what we get to later in the beginning of in the late 19th and early 20th century. But at this point, the idea established under classical economic theory was that supply creates its own demand, that the economy will operate at full potential automatically. The government doesn't need to do anything because the quantity demanded will always equal the quantity supplied. What is that called? That's called the market clearing function. Then, of course, moved on to David Ricardo, who took it one step further and said that trading gains were based on relative efficiencies and comparative advantages as opposed to just absolute advantages. It's important to remember that David Ricardo also uses the labor theory of value, that labor is homogeneous. It is the single factor of production. He doesn't tell us what accounts for the terms of trade between nations. That we get from John Stuart Mill, who tells us that the terms of trade are determined by the reciprocal demand. a point came up in class the other day. I just want to clarify. What Smith made clear was that the demand strength, that nations of equal size will share in the benefits of trade equally. But two nations of unequal size, the smaller nation's demand structure will be dwarfed by the larger nation. However, well, not however, the small nation, as we pointed out last week, becomes a price taker, right? Because it has no ability to influence the market. At the same time, though, the small nation can benefit more, can achieve higher trading gains than the larger nation. Why? Because all of its supply will be absorbed, and what of its demands will be absorbed because it's a smaller nation. The book uses the example of a nation's the importance of being unimportant. And the example I think the book uses that's I think instructive is Venezuela and the United States in the oil markets, and or Venezuela's position as a price taker in the oil markets. And of course, before the oil markets really collapsed, Venezuela was doing much better than it is now. But I don't want to spend time on Venezuela beyond that. From John Stuart Mill, we moved on to Keynes, who was opposed to Jean-Baptiste Say, who thought that the fundamental problem in the economy was one of supply. What he said was the fundamental problem in the economy is one of demand, and that economic distress requires active policy responses from the government, both fiscal policy and monetary policy, as a means to stabilize output and increase demand. So that's where we left it. What's the next question, though? The next question, though, is what determines comparative advantage? Excuse me. And so John Maynard Keynes was doing his work in the early part of the 20th century and comes to the attention of Roosevelt in the 20s and the 30s. It was during the 1920s that two economists developed a theory called the factor endowment theory, and said that multiple factors of production are what determine comparative advantage, which of course is a departure from what we heard under David Ricardo and of course Adam Smith and the entire labor theory of value. This is known as the Hector-Olin theory, which is the also known as the factor endowment theory. Are there any questions here so far? Okay. So what Hector-Olin tells us that the immediate basis for trade is the pre-trade difference in product prices. The idea that a nation's going to trade based on its relative factor endowments relative to one nation. So Hector-Olin considers labor and capital the key factors of production and examines the capital-labor ratios between nations, so that if the U.S. is more capital endowed as opposed to China, which is more labor endowed than the U.S., then each will trade based upon their comparative factor endowments. The U.S. will trade based upon the Hector-Olin theory. Capital intensive will produce and export capital intensive products, while China will produce and export labor intensive products. Again, that nations' factor endowments and resource endowment ratio, as I just said, determines comparative advantage, and says what are the determinants of comparative advantage and what is the effect that trade has on the earnings of those production factors, most specifically capital and labor. Hector and Olin told us that a nation's factor endowments will predict its patterns of trade. So again, in the example of China and the U.S., which is capital endowed, will produce and export capital endowed, capital intensive products, whereas China will produce and export labor intensive products. Here, the nation-based trades based on its abundance of available production factors, exporting those goods that in production use a large amount of its relatively abundant resource, I'm just reading here, and importing goods that in production use its relatively scarcely resource, which is unskilled labor in the United States. It's not that the U.S. doesn't have unskilled labor or semi-skilled labor, it's that it doesn't have as much relative to China. What Hector-Olin does is it assumes all labor is identical, that the technology and demand structures are approximately the same between countries, which of course we know is not true. But again, modern trade theory and modern economic theory is evolving from mercantilism back in the 15 to 1800s, through to the early part of the 20th century, having made an enormous leap from mercantilism to what is now modern economic theory under Keynes and Hector Olin, which begin to examine the sources of comparative advantage. What Hector Olin doesn't do is explain why two-way trade exists. In other words, why do nations trade steel and cars at the same time? They import them and they export them. We don't get that till later. We talk about the Stolper-Samuelson effect and the specific factors theory. The Stolper-Samuelson theory we'll talk about, I think, on Wednesday, and specific factors theory, I think that we'll also talk about on Wednesday as we look more deeply into chapter 3. Just pardon me here for a second. Are there any questions here? The sum and substance of Hector Olin is the factor endowment theory. Nations trade based upon their factor endowments. That's the top line takeaway here. So it says that differences in relative resource endowments, capital to labor, lead to the differences in relative resource prices, which leads to the difference in relative product prices, which leads to patterns of comparative advantage. Okay? So we talk about China and the US here and the production of textiles and aircraft. And what do we see? We see that clearly, based upon the production possibility schedules of both nations, China has a bias in the production of textiles and the US has a bias in the production of aircraft. If I say anything that doesn't ring true or doesn't make sense, please jump in and ask me, folks. Okay, so we see the biases of both countries, as I point out here. So Hector Olin tells us the pre-trade product price differences are due to the difference in relative resource abundance, i.e., China is abundant in labor, US is abundant in capital. So we see pre-specialization autarky given by point A. Excuse me. So we see the marginal rate of transformation in textiles into aircraft in China is 4.0, as opposed to the US where it's 1/3. So that means that the US has a clear comparative advantage in the production of aircraft, and China has a clear comparative advantage in the production of textiles. And the expectation is that both will move along their production possibility schedules so that they are each producing where they are most efficient. China producing textiles, the US producing aircraft. Again, my note here is that the US shows a relative lower price for aircraft and China a lower relative price for textile production. Again, repeating what I just said in terms of their comparative advantages and what we expect the direction of trade to be. So here we say that with trade, both nations continue to specialize because China is moving up its production possibility schedule here to its post-specialization production point here. Yes? So it went from producing 6 units of textiles to producing 13 units of textiles, whereas the United States moved down its production possibility schedule and went from producing 7 units of aircraft or 7 aircraft to producing 15 units of aircraft. Each nation has exploited their factor endowments in order to be competitive. Okay. So we draw a common relative price line, and I'm telling you that the terms of trade between the two nations is 1-for-1. So the common relative price line, as I point out here, becomes the equilibrium terms for trade or the trading possibility line. Okay. What we've done is we've drawn a line between the post-specialization production points of both nations. Now we see the post-trade consumption point. So the US and China choose point C here as the post-trade consumption point. In the next slide, what do we see? We see that the US, which has moving up its trading possibility line here, the US is exporting 6 aircraft. Yes? The US is exporting 6 aircraft. Those 6 aircraft become imports in China, which imports 6 aircraft here. China is producing 3 aircraft. It's going to import 6, so it ends up consuming 9 aircraft. The US was producing and consuming 9. It ends up producing 15. Its consumption remains the same. It exports the difference, which becomes the 6 aircraft being imported by China. At the same time, China is moving along its trading possibility line here to point C. China is exporting 6 units of textiles. It's going to, it's exporting, excuse me. China is exporting its 6 units of textiles at the same time that the U.S. is importing 6 units of textiles. Does everybody see that?
So the US continues to produce one unit of textile, right? And
The U.S.
imports the
continues to
6.
produce. That's exactly right. It sure does.
And same for China, produced 3 aircrafts and then imports the 6.
That's exactly
and
right. That's
ends at 9.
exactly right.
Okay.
That's exactly right. So China exports 6, U.S. imports 6. Beyond point C is beyond point A here, so we know that both nations are gaining from trade. So here we see our trade triangle. We have our terms of trade, our imports, and our exports, which define the trade triangle. Okay. Okay. So here we see an autarky equilibrium and post-trade equilibrium. We started at A, we end up at C. We've gone through all the mechanics of how we got to C. And if there are no more questions here, I'm going to move on and we're going to take a look here. How does resource abundance determine comparative advantage? Well, so we see resource in the US at 100 machines and 200 workers. The capital labor ratio is 0.5. In China, 20 machines to 1,000 workers. The capital labor ratio is 0.02. That means the US has an advantage in the production of capital-intensive goods and a disadvantage in the production of labor-intensive goods. The exact opposite of true, of course, is for China. So I say CL ratios imply US is capital abundant, labor scarce relative to China, which is capital scarce, and labor abundant, which is just another way to say what I just said before. Does everybody understand this? The key here is capital labor ratios. That's the key. That is the essence of Hector Olin, factor endowments and capital labor ratios. Okay, so the theory implies that each nation should export the goods that use intensively the factors in production of which it is abundantly supplied. So in the example of the US, capital intensive goods, and China, labor intensive goods. So again, the US will export capital intensive goods like scientific instruments and semiconductors and airplanes, while China exports labor intensive goods like textiles and apparel. Okay? So following Keynes in the 1920s and 30s, having such a profound influence on the direction of American policy and on the direction of modern trade and economic theory, we have Hector Olin, followed by, and here, let's just back up a second. I forgot about this slide I put in. So we talk about the ratio of factors that matter most. Again, the point here is that the US is endowed with labor, low-skilled, semi-skilled, and high-skilled labor. But in terms of low-skilled labor, China clearly is more abundant than the United States, and therefore, based upon Hector Olin, should focus and produce and export goods that rely on its abundant resource, which is low and semi-skilled labor. So again, getting back to my point before, we move on to Keynes, and we talk about modern economic theory and the role of government. That becomes refined under Hector Olin. And then, of course, the question is what is the effect of trade on the returns to various factors? So the question we were just asking now is what determines comparative advantage? Hector Olin tells us that a nation trades based on its abundance of available production factors. Patterns of trade are based on factor endowments and capital labor ratios. Now the question is how does trade affect the distribution of income among the various factors of production? Well, the first theory that we talk about is the factor price equalization theory, which says that trade tends to equalize the return to factors among trading nations. So what happens to the price of low-skilled labor when NAFTA starts out in the 1990s? What happens to the price of low-skilled labor in the United States when trade begins under NAFTA? Does anyone have an idea? When trade begins under NAFTA, we begin to see movement
Decrease.
of low-skilled labor, of production requiring low-skilled labor being outsourced into low-cost labor platform markets like Mexico as opposed to China. We've talked about that. And so what happens to the price of labor on that type of labor in the United States? Is there downward pressure or upward pressure?
There is downward pressure because
There is downward pressure on the price of
supply.
there is downward pressure on the price of low-skilled labor in the United States. At the same time, there's upward pressure on the price of low-skilled labor in Mexico, which is where you get the idea of factor price equalization. So in the example we just looked at, as the U.S. demand for Chinese textiles leads to increased demand for its abundant resource labor, the price of labor rises in China, falls in the United States, and China's demand for U.S. aircraft leads for the U.S. demand for its abundant resource, which is capital, to rise in the United States and fall in China. So here is the example with I use here with NAFTA. Wages for identical jobs in both nations tend to approach each other. So you see unskilled labor unskilled wages gradually falling in the U.S., that they're gradually increasing in Mexico following the NAFTA adoption of NAFTA. So one of the interesting things we've seen with outsourcing is how things like computer engineering services, how free trade becomes a substitute for immigration. So things like computer engineering services in India are transmitted online. And so instead of needing immigration, it's just free trade that becomes a substitute for the immigration itself. And so you see increasing competition that narrows the wage gap between India and the United States for such things as software design or accounting or other types of services, back office services that can be provided now very robustly from foreign markets, as we see more and more white collar labor, higher skilled labor being outsourced abroad. Okay, any questions on this about factor price equalization? No? Okay, it's relatively straightforward theory. Let's take a look here. We talk about how trade alters the mix of factors used in production. Yesterday, I'm just thinking back what we talked about last week when we looked at trade between Japan and the United States and how trade led to a change in the direction. The trade led to a direction in comparative advantage. That country, that the U.S. was able to achieve a comparative advantage through production gains, at the same time that Japan was able to achieve a comparative advantage in its production gains. Here we say how trade will alter a mix of factors used in production. We see that in the United States, which is capital intensive, it is bias is to produce aircraft, as we saw earlier, and we see what's happening to the price of capital. The price of capital is, during trade, is falling in China just as it's increasing in the United States as the demand for capital rises, as U.S. producers look to borrow more money to produce the airplanes that China is going to buy. Okay, at the same time, we see labor, we see China's bias for labor-intensive production. And what's happening is that once trade begins, we see that the price of labor in the U.S. falls and the price of labor in China, similar labor, rises. The example I use with Mexico is equally appropriate. But again, the idea of factors of production, the cost of these factors of production moving towards one another once trade begins. Okay, any questions here? Okay, good. Okay, then let's move on. We know that factor price equalization is not fully realized. Why? Because there are differences in things like technology, education, training, the skills that exist across nations, transportation costs, and trade barriers, which is why they don't reach complete equilibrium, i.e. semi-skilled or skilled or low-skilled labor in the U.S. versus Mexico or the U.S. versus China. They don't move into perfect equilibrium. Okay, so that ends our section for tonight on modern trade theory. As I said, on Wednesday, we're going to finish chapter 3, and we're going to talk about Stoper-Samuelson theory about trade and abundant factors, and we're going to talk about the specific factors theory and a number of other things as we wrap up chapter 3. And the next week, we're going to talk about tariffs in chapter 4. So you should have finished chapter 3 by Wednesday. We're going to finish that up. I'm going to assign the homework on Wednesday for chapter 3. And then next week, we're going to talk about tariffs. The following Monday, we'll have a review, and then the exam will be on Wednesday, the 24th, I think it is. So everybody wants to stay up to date on the material that we're going through. Now, though, I'd like to turn our attention to some hedging. Okay, so we've looked at hedging receivables and hedging payables. We've looked at two techniques, either a forward hedge or money market hedge. Are there any questions on the chart that's in front of you, folks? No? Okay. Well, let's go through a couple of examples because I gave you two examples on Wednesday of last week. We had two account receivable problems, both companies looking to hedge an account receivable, one in Jordanian dinar and the other in Great British pound. So let's look at the dinar question. So here you've got ABC company that's receiving 350,000 Jordanian dinar in 1 year. The spot rate of the dinar is $1.41. The 1 year forward is $1.44. And the question is, how much does the company expect to have in 1 year after implementing a forward or money market hedge? What are the potential cash flows and break-even rate between the two techniques? You're given the 1 year borrow rates in the US and Jordan, and the 1 year borrow rates in the deposit rates in both countries. I jumped ahead there just real quick. So we talk about first to do the forward hedge. So of course, we can exchange our dinar in 1 year at the forward rate of $1.44, which means we would net 504,000. On a money market hedge, what are we going to do? We're going to borrow against our receivables. We're going to borrow against our receivables at what rate? Can anyone tell us? We have Jordanian dinar coming in.
5%.
You're going to borrow at 5%. So you've got to discount your receivables by 5%. That gives you a present value of 333,333 dinar. At the current spot rate, that's $470,000, which you'll get at time 0. That money, of course, can be invested in the United States then at 5%. At the same time, what's the interest rate on the loan? It's 5% over the course of the year for a total cost of $16,667, which plus the loan amount, the principal amount, gives you the $350 that's going to be retired when the receivable comes in. Meanwhile, you got your dinar out of the market, you converted it to dollars, you invest it in the US at 5%, you ended up with 493,500. So clearly, the technique here to use, given current conditions, would be, of course, the forward hedge. We'd like to know, though, what is the break-even rate between the two techniques? Well, all we're doing is setting up a present value formula. We say that the present value of the loan proceeds, which is the 470 multiplied by a rate plus 1, equals my forward proceeds of 504. You solve for the equation, you get a rate equals 7.23%. If the company can find a rate equal to 7.23%, it's going to be indifferent between the two techniques given equivalent transaction costs. Are there any questions on this problem and how we solved it? You will get a problem like this on the midterm.
Professor?
Yeah.
Is it safe to say that if the forward hedge is hard on the currency, we will make more money through the forward hedge than the money market hedge? Depending, having the same interest rates of borrowing and depositing.
In this case, yes, you would. In this case, yes, you would. Yes.
Okay.
Okay. Yeah, in this case, you would. Let's look at the next problem. So here we have a company based out here in Queens, in Elmhurst. They're a metal fabricator. They had a 6-month receivable on 526,000 pounds. They're considering, again, a forward or money market hedge. What are the 6-month cash flows? Give us the loan proceeds, the cost, the investment income, the break-even point, break-even rate. So you have the US and UK rate is 3.75 and 4% respectively. The 6-month forward is $1.28, excuse me, and the pound spot is $1.30. So the forward hedge, it's just the principal of the receivable multiplied by the forward rate, which is $1.28, right? Here, was the market hard or soft on the pound?
It's hard.
Harder.
Oh, I'm sorry, it's soft. It's soft. Forward rate is 0.28.
Because now the
1.28.
forward, the pound buys me $1.30, and at 6 months, it's expected to only buy me $1.28. So that means we expect the pound to weaken while the dollar would strengthen. So let's see. So we've got to discount by the relevant rate. At 6 months, we have to discount by the 1/2 of the relevant UK rate, which is 2%. That gives us a value, present value in pounds, of 515,686 pounds. Multiply that, that's the loan. Multiply that by the spot. The $1.30 gives us a net at time zero of 670,392, which we can then invest in the United States at 1/2 of 375. The interest on the loan is also 2%. That's 10,314, which plus the loan of 515,686 gives us the 526. We invested at 1.875%, which is 1/2 of the annual 375. We end up with 682,962. So in this case, it was better to follow the money market hedge than it would be to follow the forward hedge. What's the break-even rate here? Again, we solve. The loan proceeds were the 670,392 times the rate equals what the potential forward proceeds are, gives us a rate of 0.43%. So at a rate of 4.43% or greater, the company would be indifferent between the two pathways given equivalent transaction costs. Okay, are there any
Professor?
questions? Yep, sure, go ahead.
On the money market hedge loan proceeds, why do you divide by 102?
Can somebody tell us why we divide by 1.02?
This ha-
We're given the UK rate, and we're looking at the 6-month forward rate. So we have to divide the UK rate by 2, since there's 2 6-month periods in a year.
Yeah. I understand that, but why on the loan proceeds we divide by
Because you're borrowing against because you're borrowing in the UK against your pound receivables. You're borrowing in the UK bank against your pound receivables at the
Okay.
relevant UK rate.
But okay,
In
understand.
other words, you're pulling money out of the UK market in the pound market, and you're converting into the dollars, and you're investing it in the US market. So
Then the 10,000, that's the loan cost. It's gonna be the total of the loan that we get at 515 and 10,000. It's gonna be 526, right?
that's exactly right. So that
Okay.
means that in 6 months' time, you're pulling your money out of the market. You created a money market liability. The liability is the
Yes.
loan. So the loan plus the
Base
fee is going to equal your receivable. So
Makes sense now.
right.
Thank you.
You're creating a liability, but you're also creating an asset at the same time. So now let's take a look at a payable problem. So here we have a question that's saying, hold on a second. Okay. What is the cost of forward, the money market hedge on accounts payable 200,000 pounds due in 6 months? I tell you, the firm has no excess cash. The pound spot is 202. The forward rate is $2. Assume the 6-month rates in the UK are 7% and the US 5%. So let's go through the same exercise. And what do we see? We see, well, the forward's going to be 200,000 times $2 gives me a cost of 400,000. if I want to invest against my payables, what am I going to do? I'm going to invest in the local bank. I'm going to invest in the UK bank, an amount of money that's going to grow to equal my payables during the term, during the 6 months. So I've got to discount the payable amount by the relevant rate, which is 7%, which means that I need to deposit 186,916 pounds in a bank at 7% for 6 months to equal my payable of 200,000 pounds. So if I borrow that at home, that's going to cost me, at the current dollar rates, pardon me, we're not borrowing it yet. What is that in US dollar terms? It's 377,570. If I borrow that in the United States at 5%, that's going to cost me $396,449, which is about $3,500 less than the forward would cost me. So in this case, it would be better to pursue the money market hedge to hedge against the rising currency and what could be a more expensive payable in your home currency terms. Are there any questions here? Yep. No? Okay, good. So let's move forward. Let's talk about options. And again, I have in front of me 3 pages of notes between some of you from last week's class. I think it was last week's class. And again, some very impressive comments I thought about the options markets. And so obviously there are folks out here who know what they're talking about. So if you have any comments or thoughts along the way, or of course corrections, please jump in. Everyone else, let's just pay attention and see if we can get through this before we close for the evening. So options really came about in the early 1970s as a great way to hedge risk. What's great about options? They're cheap. They're very cheap relative to what you're looking to protect. They're very liquid. It's a huge, thickly traded market, and they're very low risk. Why are options low risk? Can someone tell us? Why are options low risk?
Because you don't have the obligation to pay, you just have the option to.
Thank you. Thank you very much. You have the right, but not the obligation to buy or sell something. You have the right, but not the obligation to buy or sell something. That's exactly right. And so that means that your exposure is limited to what?
Your investment?
The exposure is limited to the cost of the option. And as we said, options are cheap. So let's go ahead. You got 2 types of options, a European option and an American option. A European option can only be exercised at maturity or expiration. An American option, which you would assume is preferable, can be exercised at any time up until the expiration date. So a call option, as we said earlier in the semester, gives the owner the right to buy foreign exchange. A put option gives the owner the right to sell foreign exchange. In this case, we're talking about foreign exchange, but a call or put option can give you the right to buy or sell just about anything. But, excuse me, for our purposes, we're talking about foreign exchange with a call and put options. So we distinguish between plain vanilla options, which are your standard call and put options, and more exotic options like swaps and collars and straddles and strangles. We're going to get to swaps, collars, straddles, and strangles later in the semester, but that will follow the midterm. For the time being, ahead of the midterm and for the midterm, we're going to just focus on plain vanilla calls and puts. So what are the various option elements? Well, there's the underlying or spot price of the foreign exchange today. There's the exercise or strike price, the price at which you can buy or sell a particular currency. There's the premium, which is the cost of the option. So we said before, what's your exposure on the option? It's the premium cost. Your risk is limited to the cost of the premium. That's it, the cost of the option. And then, of course, there's the time to maturity. Now, how are options priced? Can anyone tell us how options are priced? What the common model is? Well, the common model is the Black-Scholes option pricing model, which takes into consideration the intrinsic value and time value. What's the value of the option if I exercise it today? Plus, what is the value that I'm giving up if I exercise it before expiration? Okay. Now, Black-Scholes are 2 economists who won Nobel Prizes for developing the option pricing model, which is what we use all over the world today to price options. It incorporates, their model incorporates time to maturity, the spot strike spread, the spread between the price of today and what you have the right to exercise at, whatever the risk-free rate is on the comparable treasury paper, and what the volatility, the underlying volatility of the currency. The more volatile the currency, the more valuable the option. The longer the time to expiration, the more valuable the option is. The longer the time to maturity, the more valuable the option is. So Black-Scholes, again, considers intrinsic value plus the premium, which equals time value. And Black-Scholes holds that the investor will never exercise early because the investor never wants to give up their time value. Okay? Are there any questions on this and option pricing? I take that as a no. Every semester, when we bring up option pricing, people come back to me and they ask me to show them the formula for Black-Scholes, and subsequently I do. So this is the formula for Black-Scholes. It's the value of a call option, the value of a put option. As you can see, there are logarithmic functions here. It includes all the elements that we talked about here under option pricing. I'm providing this to you like I provided for you the breakdown on the New Deal under Roosevelt. It's for information purposes. I'm not going to test you on the actual formula itself. There are other formulas I will test you on, but not on this. But I provide this for you for information purposes. So let's take a look at how call options work, and then let's get to an example. Okay. Again, any questions, please let me know. So here we see the strike price, the spot price, and the value of a call option. So we know that the call option holder has the right but not the obligation to buy a fixed amount of foreign exchange within a fixed period of time. Yes? So we know that the loss is limited to the premium cost. So everything before the strike price represents the premium cost. Once we are above the strike price on a call option, what is this area here? What's happening here? The investor is recovering their premium cost. Everything beyond this point is what? Everything beyond this point is pure profit, pure profit. Thank you. So we know the call option benefits from any spot price greater than the strike price. We know that the call option holder optimized buying at a low strike and exercising at a high spot. So let's say you have call options to, well, let's say you have call options to buy. I'm trying to think of a good example to give you of a stock that's in the market. Let's talk about Facebook. Where's Facebook trading at about 260? So let's say you have an option to buy Facebook at 270 and Facebook goes to 300. Is that a valuable option?
You're in the money.
You have a valuable option that's, you jumped ahead of me there, it's in the money. In other words, you have the right to buy Facebook stock at 270 and it's trading at 300. Well, that means you've made 30 bucks a share, right? So here we say that when the spot price equals the strike price, the option is at the money. When the spot price is greater than the strike price, as we just talked about in our example with Facebook, the option is in the money. When the spot price is less than the strike price, it's out of the money. As you see here, I've illustrated for you that any point above X here represents pure profit because this is your premium cost. You've recovered your cost, so you've recovered the cost of the premium here, and then you've got your profit. And of course, you're responsible for understanding the mechanics here. Are there any questions on this? Okay, good. That's great. So again, as I mentioned before, the call option premiums, the cost of the option is higher when there's a greater spread between the spot and strike price, when there's greater volatility, the underlying, and greater time to maturity, longer maturity and greater volatility, the underlying, just like I said. So again, before we move into an example in our last 10 minutes, are there any questions here?
So just to clarify, at the money, what was that?
At the money means the strike price equals the spot price. It's worthless. your option is worthless, right? If I bought a call option on Facebook and the spot price, if the strike price is 270 and at expiration, the spot price is 270, there's no value there. Yes?
Understand now.
Right. It expires worthless. The option expires worthless. The only time the option is worth anything is when it's in the money. So let's look at an example. We have a US multinational that has a 1-year accounts payable Singapore dollar 1 million. We have the Singapore dollar spot rate, the forward rate. So right now, the Singapore dollar buys me 60 cents. In a year, it's going to buy me 62 cents. That means that the market thinks that the Singapore dollar will strengthen. I've given you the 1-year strike on the call option. You have a 60 cent. It's 60 cents. The premium is 3 cents per unit. The expected spot rates that the company has generated are 56, 64, and 67 cents, with the probabilities of those spot rates indicated. The borrow rate in Singapore is 6%, the deposit rate is 5%, and the borrow and investment rates in the US are 7% and 6% respectively. So let's go forward and see what we're going to do in terms of trying to hedge the risk of this payable, 1 million Singapore dollar payable. The fear being that the Singapore dollar will move against us, and of course, that will mean that our dollar costs will only increase. So for the forward hedge, we go back to our original technique, which is just simply the payable of 1 million Singapore dollars multiplied by the forward rate of 62 cents means it's going to cost us $620,000. If we want to invest against our payables, well, we've got to deposit an amount of money into Singapore we've got to invest an amount of money in Singapore at a rate of 5%. Yes? So we've got to discount our payable principal amount by 5% to tell us what is the current Singapore dollar amount of that payable. It's 952,381, which if we deposit for 1 year at 5% in the Singapore bank is going to get us to our 1 million. That Singapore dollar deposit amount is what in US dollar terms? Well, it's 60 cents, which is the spot rate. It's 571,429. If we borrow that in the US at 7%, that's going to cost us 611,429. So right now, it looks like the money market hedge is the best strategy to hedge this accounts payable. Are there any questions here? Okay, good. Well then, let's move ahead. So here, we're laying out our analysis for the call option hedge, okay? So we know that, we know that the premium is 3 cents per unit. We know that the strike is 60 cents. We know that the expected spot rates were given, and I've indicated here for you the probabilities that were given. Now we know that if the spot rate is 56 cents and the strike rate is 60 cents, is the company going to exercise yes or no?
Nope.
No.
It's not going to exercise because it could do what? It could buy in the spot market at 56 cents. Isn't that right? As opposed to at 60 cents to cover its Singapore dollar payable. So we know that the answer is no. We know that the cost paid per unit is going to be 59 cents. Why is it 59 cents? Can anyone tell us?
3 cents from the premium and 56 from the spot rate.
Thanks, Alec. That's fantastic. Everyone's got to keep that in mind. You're always responsible for the premium cost. Okay. So in the next two cases, though, will the company exercise? Well, it can either buy Singapore dollars at 64 cents, 67 cents, or 60 cents. So in the second and third cases, you've got in the money call options. So of course, the company is going to exercise in both cases, which means it's exercising at 60 plus the 3 cents or 63 cents gives us 630,000 for the cost in both cases. So what does this information do for me? Well, we can set up a probability distribution and say, well, what is the expected cost? It's the 590 times 40% plus the 630 times the 25% and the 630 times the 35%. gives me an expected cost of 614 on the call option hedge. So now if we lay out what would happen if it was unhedged, we're completely unhedged, and we look at our expected spot rates and what it's going to cost us. At 56 cents, it costs us 560 or 640 or 670, depending upon what the spot rates are in scenarios 2 and 3. We can still do a probability distribution here that shows us an expected cost, as you would expect higher without the call option, of 618,500. So where does that leave us? We've looked at 4 options. We've got a forward hedge, which generates a potential cost of 620, a money market hedge at 611,429, a call option hedge at 614, or no option, no hedge, we're at 618,500. So clearly, in this case, the best way for the company to hedge its Singapore dollar costs is going to be the money market hedge. Is
Professor,
everybody with me? Yeah.
can you explain number 4 again on hedged?
Number 4, sure. Well, we looked at here is we said, what if the company is totally unhedged? And a year down the road, they've got to go out and buy Singapore dollars. Well, it's Singapore dollars. What cost? Well, based upon the company's own internal analysis, they expect the spot rate's going to look like one of these 3 in 3 different scenarios.
I
And our
understand.
job is and our job is to say what's the expected cost based upon the probability distribution and compare that potential outcome with the other 3. And then the answer here on an exam would be option number 2, the money market hedge at 611,429 is the way to go in this case. And yeah, I'm pretty sure
Professor.
that brings, yeah.
So when it's account payable, it's the one that's the least, and when it's account receivable, it's the one that's the most. Right?
Well, you want to optimize your return. You want to minimize your costs. So sure, of course, absolutely. Hey, everybody. That was a good, tight evening tonight. I want to thank you all for your attention tonight. As I said, I posted for you chapter 2 that's been up all day. You have no homework other than finishing chapter 3 ahead of Wednesday. And I wish you all a good, safe continuation of your evening tonight and tomorrow, and look forward to seeing you again on Wednesday. Okay, folks, thank you very much. These slides will be up in the next hour, okay?
Professor, I have a really